Let me start with the conclusion, Neeraj. The taxability of this is going to hold critical fort if you are an Infosys shareholder and going to opt for buyback. So you really do want to listen to this one. Let's talk about what the law says. Buyback proceeds are taxed as dividend income, not as capital gains. And dividend income, so basically the full 1800 rupees will be taxed as dividend income in your hands. That's the first piece of the law. Company will deduct a 10% of the buyback value as tax deducted at source, and no other tax will be paid by the company. So company is completely exempt. They'll pay out the 1800, but out of that 180 will be deducted as TDS, and thereafter 1620 will be paid out to the shareholder. 180 as TDS will reflect in your account. The tax paid by shareholder at income tax slab rate. So your dividend income, which is coming in at 1800, will be taxed at a slab rate. It could be 0, it could be 10, it could be 20, 30, whatever your slab rate is. That's the key component that you need to find out before you opt for this buyback offer. Capital loss, though, of course, because you've had a purchase price built into the shares that you've opted to give out for buyback, the capital loss can only be set off against other capital gains and not dividend. So you actually have to have gains to ensure that that loss gets offset. That's something you want to understand. Let's break it down into easier numbers. 1800 is your offer price for buyback. TDS deducted will be 180, which will reflect in your account, which is the shareholder's account. The net payout will be 1620 rupees in your account. Now let's talk a little bit about what the tax could be. If it's a 20%, it's 360 rupees on the 1820, and 30%, it's 540 on the 1820. That brings the gains to lesser, or rather the accrued number of profit will likely be lower for some persons. If at all you sell it even at market, that could be slightly more sensible as well for some. So you want to take note of that part. Cost of shares to be treated as capital loss. I did mention that. So that's all. And capital loss can be set off, can reduce tax only if you have other capital gains. I want to reiterate that. Last off, most relevant pieces. Shareholder falling in the higher slab rates are disincentivized from opting for this buyback. You still want to do the math with your chartered accountant, but and therefore will be subjected to higher taxation on the full 1800 rupees upfront. But again, if you have capital gains, that may vary, and cost is to be treated as capital loss and set off against capital gains. That will remain common even for shareholders in a lower income tax slab rate, but they are incentivized because you will have a far lower rate which could be payable on your total cumulative amount coming in of 1800 rupees, but you will also get a deduction likely if you have capital gains. So there is of course an incentivization for some of the lower income tax slab rates shareholders, but a disincentivization for some of the higher slab rate shareholders.